Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Rodolfo Bellesi of Ikove Capital. Rodolfo, thank you for joining us.
Thank you for having me.
So what was your background before starting to invest in early stage companies?
Well, I'm an engineer, electrical engineer. I have a master's at Ohio State. I pursued an MBA out of Babson College when I worked in Boston. But I actually started with real estate development. I mean, once I finished my 4 or 5 year program working for a company out of Boston called Teradyne, I went back to Brazil, started a real estate development company. Very successful, still in existence. My focus on the technology side, always something that was really my passion. And then I got a call back from my alma mater, came back to visit Ohio State, and realized there was an opportunity to, quote, invest where they only saw charitable donations. And so like the model of bringing back some resources and investing in university technology, that's what kind of created Ikove.
Oh, great. So you started Ikove, and so before we get into it, what's your advice for people investing in early stage startups? What would you tell a new investor what to do before they started actually writing checks?
Well, first, evaluate the team, right? I mean, people look a lot at technologies, and I think the team has to be solid. So the inventor and whoever is managing the team. I try to avoid technical teams that try to run their own business. So I think each one should be careful about focusing on their specialty. So the inventor usually should be focusing on the technical development of whatever product or service or software. And also if there's a market, right? I mean, I know a lot of great companies, a lot of unicorns were created before the market was actually created. But I would say that's very risky. And I would identify a pull from the market in order to invest in the technology early on.
Well, great. Well, you're now moving into a venture development, venture studio role. Maybe you can tell us a little bit more about that and how it works.
Our model is a little bit different. We focus on licensing technology from institutions like universities and research labs. And we work very closely with those institutions and the inventor team. Usually we end up hiring the graduate student that was part of that research team as the first technical member of that particular startup. And we have the entire support or shared resources, like we call in our startup nursery process. We call it startup nursery because it is a metaphor to what we try to do, provide for a seed, which is the technology early stage with the best resources we can have. Senior legal advisor, and IP strategy, finance and accounting support, design, creative, project management, entrepreneur in residence. So we do not work with unseasoned staff. We do have junior members of the team, but that they work with very senior mentors and leaders. So we make sure that we de-risk the investment in a startup by having a senior, more mature, more seasoned set of resources and human resources and financial resources in place.
So what is the biggest change you see in the venture development world? It seems like the studio model is one of them. And what do you think is driving the change that's going on in the venture capital industry behind it?
I think in the past, venture capital was really like the second check we would see. You would go to your family, relatives, and friends, and that had a little bit of inclination to risk, and it would put the first like $50,000 into your company. Now I see venture capital as being really Series A, Series B. No one is investing what we call the value depth between concept and seed or seed B. And that's something that changed. So that also initiated this idea that incubators and accelerators by themselves are not enough, right? You have to be more hands-on. There's a capacity issue. You can't do more than a few companies a year. Doesn't matter how good you are, because you want to do those companies properly. You don't want them to fail at all. You don't want to be 1 out of 10. You want to be, if you can, 10 out of 10. So that is the biggest difference. Is the move of venture capital to a later stage in the process.
And so, what's the challenge in putting a venture studio program together? You have to license technology, you have to build teams, you have to form companies. There's a lot of new things going on there, but what do you see as the biggest challenge?
Well, you need to create your own ecosystem, right? I mean, most communities are not used to having this shared model where most inventors and founders believe that they are sitting on the top of the only great idea there is. So they're going to be focusing on that one vertical, while the startup studio model is a model that benefits from volume and not necessarily unrelated volume. We do correlate technology. So senior engineer that is working at a company might provide support to another company. The same network of investors that come in and make an investment in two or three of the companies might be interested in the fourth and the fifth. And so there's a gain of a scale. There's a de-risking natural progression of doing things over and over, because there are many things that you repeat. It's not, technologies don't need to be similar for business processes and procedures to be similar.
And are there certain technologies that lend themselves to the venture studio model, or certain applications that fit better than others? For example, does pure software development work here, or is it for more complex startups?
I would say any technology works well. I mean, we do have medical devices that follow a little bit of a longer path through the regulatory hurdles of, for example, the FDA or CE marking if you're doing business in Europe. But you also have easier to enter markets like the SaaS market, where you can come out. We do not invest in apps, but we do invest in certain software as a service products and companies. I would say any deep technology startup would benefit from a startup studio model.
What are some examples, say a couple of portfolio companies that fit that model and have done well with it?
We have a portfolio of medtech companies, medical devices companies that are funded on a much larger technical team that would not be possible if we were just going to launch one company out of that. So we needed expertise in the team that would not be supported by one company. So we created a model to launch 4 companies in parallel, going specifically to different areas of either of the body or levels of application. And that would allow us to have the senior development team in place. So I would say MedTech is definitely something that benefits a lot from this model. We have another company in wireless power, Nikola Labs. It is a company that is very dear to us. It was the first company we launched out of a nursery. And it's a company that is going into the industrial space, preventive maintenance. So it is truly deep tech company that requires enormous resources, and the resources will only be available either with a lot of investment or shared with other startups like we do in the Ikove startup nursery.
And how long do the companies stay in the nursery before they're ready to go out and stand up on their own?
That is a good question, because stand up on their own is, if you look at even companies that have recently filed their IPOs, they're always raising. In the IPO situation, they now had in the down round. So I would say that we're always there for the companies. But on average, I would say between 18 months to 24 months, that's when we end up hiring a dedicated CEO. We might have 2 or 3 dedicated staff that can work with the shared resources we have in the nursery. Some of those companies move to different addresses. It may be that we need to go to the West Coast. We have a company there. We have a couple in New York. So that is an organic growth of the company. So I would say yes, between 18 and 24 months has been the average out of our portfolio.
Well, are there any particular sectors or applications you see out there today that are great immediate opportunities to pursue?
I do love the gene therapy space. I think it's complex, it's expensive, but I think it's going to provide breakthrough solutions to main issues in the human body and human condition. And I would also say that in the same area of healthcare, personalized healthcare is something that is definitely going to be very, very strong in the next 10 years here in the U.S.
Great. Well, in the last few minutes that we have here today, what else should we cover that we haven't?
I would make a recommendation to any region, anyone who has either job growth or any responsibility for their geographical region in the country, is that you need to develop an ecosystem where there is a lot of communication. There is support from state and city agencies and from non-for-profit, but also from angel investors and maybe family offices, in this idea of surrounding yourself with seasoned entrepreneurs and great professionals that can collaborate. And so my message is ecosystem. It's a word that is used a lot, but it's very rare when you see an ecosystem that really provides and allows for startups to have a greater shot of success.
Well, that's great. Well, how best for listeners to get back in touch with you?
Yes, through our website, we have basically a little bit of a snippet of every company in the portfolio, what we do. We're located geographically, the team, and LinkedIn is always a good. We do have a Twitter account, an Instagram account that we use. But yes, info@ikovecapital.com, and that's it.
Well, great. Well, we'll put that in the show notes and let people get back in touch with you. Thank you for taking time to share your program with us today, and hope to have you back for a follow-up soon.
Thank you very much for the invitation, and you're doing a great job and a great service to our community.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.